Oh, look at futures. We're still continuing the sell-off, not quite as dramatically as about 10 minutes ago, but we're going to be down at 9:30. Gregg Smith joins us. You're telling investors, prepare for a sell-off. All right. How do you prepare for a sell-off? What do you do?
Hey, good morning, Stuart. Look, while I continue to be long the market, I would encourage investors, as we might be on the precipice of a correction in the market, to think about de-risking their equity portfolio. So in a correction, we actually generally see investors sort of do the opposite. They generally sell their more liquid names first in an effort to raise cash. But as the environment is changing, I would constantly be reevaluating your portfolio and look at maybe lightening up on some of the more risky assets you're holding.
Well, now, what kind of stocks? Which industries would you say are risky assets? Not big tech, surely.
Well, no, I'm holding on to my big tech names. I'm prepared to watch them go down, and I'm going to stick with them. But I might want to point a spotlight on the SPAC market, for example, right? It's been a tale of two cities. We saw the year start off with absolute euphoria, right? Names were trading very well. The mergers were working. We then saw a big slowdown in the market, which was due to the fact that there was increased regulatory oversight, and then deals were just not working. So as you look at what's going on today with all the names that have actually de-SPACed and done their mergers, you're seeing actually 58 of these de-SPAC companies trade below their $10 merger price, and they're down on average about 22%. So yes, there are about 37 that have traded up, but 58 are down. And then the bigger story that I think the investing public doesn't really understand or is focused on is the redemptions in these mergers. So as you know, Stuart, when these SPACs are going through their mergers, investors can ask for their $10 back in trust. In Q1, 11%, that was a record low, 11% of investors asked for their money back. We saw that double to 24% in the second quarter. And in August, it's running at 57%, Ouch. With some deals in the 80s. So many investors are saying, I don't like this deal. I want my money back. And then we're seeing these deals trade lousy. So as we do talk about a risky asset, that might be one area of the market to look at.
Okay, I'll look at it. I think I understand it too. All right, Gregg Smith, thanks for joining us. We do appreciate it. Okay.
Thank you.
That was interesting about SPACs.
Yeah, I thought so.
Once you get through the jargon and you understand what's going on here, the fact that more than 50% of the people wanted their money back, the money that they put in, the $10 that they put in, they want it back. That's a bad sign.
Well,
I understand that.
You only have a 2-year limit to find a target to buy, and if you don't find that right target, you're supposed to give back the money to shareholders.
Yep. All right, so we bring SPAC into the argument when we've got a downside move and chaos in Afghanistan.
Yeah.
Well, the opening bell will be ringing.